Good morning, clients and friends. This is Craig Llewellyn from U.S. Investors International, and it's my pleasure to welcome you to an economic review and 2022 outlook going forward. Today we'll provide a brief review of the fourth quarter of 2021, and then we're going to have we'll kind of discuss our economic outlook for 2022. A lot going on here. Before we begin, though, it's always important to review that there are 5 areas of financial planning. These are key areas. They're preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial service firm, we try to always consider the impact of any, not just on one, but all these areas for you guys. They will be primarily focused on the investment planning and equity markets. So looking back at 2021, the U.S. stock market, it ended at just shy of an all-time high. The S&P closed the quarter at 4,766, ending the quarter up 11% and the year up 27%. This marks the 3rd consecutive year the S&P ended the year with double-digit gains. It's years in a row. We've had 4 years in a row in the past. Very rare, but it has happened. Dow Jones Industrial Average closed at 36,338, ending the quarter up almost 8%, and the year is up 19% for that index. So since the quick but sharp fall of equity markets in early 2020, post-pandemic equity markets have been primarily robust. But despite many potential detrimental events, the equity market showed resilience and prevailed, rewarding investors with notable gains during that time. 2021 saw many new records broken. The S&P 500 had 70 record closes, and the Dow also saw some significant gains with 45 record closes. Stock valuations have soared, and many analysts are crediting ultra-low interest rates and a healthy economic recovery for this surge. As you look at this 40-plus year chart of the Dow, you can easily see that stocks have increased over the long time, notwithstanding market pullbacks and dips. The sharp decline of 2020 looks a lot less threatening as you look at long-term results. This is true when you look back over the last 100 years. What was nasty ends up being not so bad over time. That's why having a solid investment strategy is an integral part of a well-devised long-term financial plan. Staying disciplined, not getting emotional, following your strategy during times of volatility can be crucial and important. We've talked about this now hard all last year. We've been talking about this. So, why investors enjoyed an overall strong return in 2021 is the monthly S&P 500 return chart shows here. Monthly returns are very inconsistent. Equity markets do not move in a straight line, and the past few years have been an excellent reminder for investors to be prepared for anything that could affect the economic environment and their own personal situation. Volatility is a part of the investment experience, and seasoned investors understand that. And that's what we need to get rid of now, are the unsophisticated investors. And these market corrections like this, they help do that. It gets the speculation out of the market. Long term, this ends up being very healthy. This is long overdue, and we've needed it. 2021 were low. In mid-March, we saw the highest 20 and 30-year yields on U.S. Treasuries for 2021. Subsequently, they dropped back down, ending the year at 1.52%, 1.94%, and 1.9% for 10, 20, and 30-year yields, respectively. 2021 was not a great year for bondholders. While today's interest rates are still historically low, the Fed is expecting to raise rates several times in the next 2 years. When interest rates rise, the demand for bonds typically falls, reducing their prices and raising their yields. Thus, 2022 will be an interesting year for bonds. Research is indicating that Treasury yields could go up, ending 2022 with a 1.5 to 2% yield on 2-year U.S. Treasuries. I've also seen analysts talking about 3%. So this, and we've talked about this a lot, especially last year for you guys that are conservative investors in that conservative risk class. The returns were not great. It's a tough time to be a conservative investor last year, this year. That will change over time, but it's been the equity markets. It's where it's been. Those of you that have had the low returns, everybody I've talked to, for the most part, you're okay with that because you don't like the other side. You don't like what we're seeing now. So that's the trade-off: risk reward. This is the trade-off. If you want the big rewards, you got to take the more risk, which means you have to go through these types of turbulent times, and it's more rocky. We'll keep talking all year long. This is your risk level. You can't have 40% returns with no risk. It just doesn't happen. As I mentioned earlier, interest rates continue to be ultra low through 2021. These rates clearly are undesirable for income-seeking investors. The average 12-month CD rate were both less than 0.2%, which is very unattractive to savers and investors. Again, being a conservative investor, it's just a tough environment to be in for that. During the Federal Open Market Committee's meeting in December, it was announced that the federal funds rate will increase to 2022, and the Fed expects 3 rate hikes this year, following by 3 more in 2023. They project that by the end of 2023, the federal funds rate will rise to 1.6 and in 2024, and end the year approximately 2.1% in 2024. Remember, this is the same Fed that said that we weren't going to be raising rates until later this year. So that's changed. So this is all subject to change. It's really going to be based on inflation. Is it coming under control? Is it getting worse? There's a lot of factors here going on. The Fed has been making lots of moves. And so they've begun the tapering process where they're not buying the bonds anymore. They're letting them expire. This last fall, with the ultimate goal of ending the pandemic-driven stimulus by mid-March of this year, several months earlier than their original goal of November 2022. In December, due to the elevated labor market inflation pressures, the Fed decided to double the pace of reduction of assets purchased beginning in mid-January. So, and they say one thing, but based on the environment, it could be something different at any given month. Inflation rose at the fastest pace in nearly 4 decades in December of 2021. The number reported was 7% versus the prior year. Seema Shah, chief strategist at Principal Global Investors, stated, and I quote, "Inflation at 7% is no joke. It's the highest annual number since 1982 and was driven not by energy prices, but by just about everything else." Though energy prices are certainly causing some grief. My analysts feel December's number could mark the peak for annual inflation readings and signs that supply streams are easing. Other experts suggest that the rampant spread of the Omicron variant could bring about new difficulties for the global supply chain. So many analysts feeling that the tapering process of the Fed could slow inflation down. Inflation is no doubt on our watch list for 2022. It's going to be a big deal. So what are the analysts forecasting for 2022? It could be a volatile year, and our goal is to keep our clients apprised of any potential activity that may affect their financial situation. In addition to continued COVID concerns, 2022 is projected to bring rising interest rates, continued but hopefully lower inflation, stimulus tapering, and a slowdown of the global economy. And let's not forget, any public policy, new tax laws will bring changes to monetary policy. So far, this Congress hasn't been able to get anything done, so nothing's changed. And believe it or not, markets like that. Markets like it when Congresses are gridlocked. They don't like the change because markets like the known. They don't like the unknown. So nothing's changing. So what does this all mean for you guys, for the investors out there? The returns we have enjoyed the last few years were well above average and the typical median of the past 20 years. However, there are still many economists that feel that with rates still low, we should be optimistic and could still look at favorable returns, just in more moderation. I think it's really good that this market's doing all this early in the year. It could set up. I think just be prepared for. In a long time since we've seen red on our statements, more than 1 month. month over month, and we could be, most normal market corrections. These take a while to play out. And it can take a few months, not a few days, like we've been used to here the last couple of years. Don't forget, the markets go up and down, and as we've been in a long expansion, long upswing, they can take a while to work the bottoms of these things out as well. While the most recent variant of coronavirus, Omicron, has been seen as much less of a threat as its predecessors, and vaccines are now widely distributed, it is still a central figure in the direction of the economy and its recovery. We were reminded in November, when news of Omicron was released, that the markets are still very vulnerable to the trajectory of the coronavirus and the introduction of the new variants, and it directly affects supply chain disruptions, labor shortages, and further downward pressure. Been saying this now for a couple of years, we'll say it again. Even though the equity markets have seen impressive returns, complacency should not settle into our attitudes toward their investment strategy, to your investment strategies. We are still standing by this mantra of proceed with caution. Again, all year long, all last year, and even the year before. We're taking income, we were looking at risk tolerance, looking at we're taking profits and bringing people back to a lower risk tolerance. We were raising money into money markets for people that are taking income, and we're doing so over a 12 to 18 month period. So that way, if we come into something like this, we don't have to take money out when markets are bad. Remember, we don't take money out. You don't want to sell when markets are down. You want to buy. Buyers in here at some point, not sellers. That's how you lose. And we're really big on this. I've been big on this really my whole career. I'm getting bigger on it, I think. We just want to maintain that an educated client is our best client. That's why we do all these workshops all year long. We do this virtual workshop. We bring you this information. I want you to understand things because I don't want you to panic and make a bad decision. That's true on those of you that have been out there speculating Bitcoin and all these things. These are the things that makes the market dangerous. Here's some other things we're looking at. With interest rates on the rise, we feel it's beneficial to review all your income producing investments. We've been doing that all last year. We're going to do it again all this year. I think I have most of you in pretty good shape. We've been talking about this for 2 years. Get these locked in. The Federal Reserve's in a different stance now. The long rate is already moving up, right? Short rates and long rates, they're two different things. The long rate's already on the rise. Maintain liquidity for all near-term leads. We've been talking about that a lot the last couple of years. We'll be talking about it harder again this year. I've been asking everybody, what is your emergency cash reserves? And nobody likes having money in the bank because it's not earning anything. Those emergency reserves are for what if we do hit the next recession? What if we wanted you to take money out of those cash reserves, not the market, because Murphy's Law says the market will be down when you need those dollars. So for those of you prior to retirement, it's really important to have a good cash cushion. What if you get laid off from your job? Breakdown, maybe you want to take that vacation, have that emergency cash reserves. Don't worry about what you're not making. It's cheap insurance. Reevaluate and confirm your cash flow needs. This is where, this again, I don't think this is the beginning of the recession. I could be wrong here, but I think it's just a long overdue market correction phase that we're in. For the markets to tell us that there's recession here would say that inflation is really going to come flying back down later this year. I don't see that. It could come down, but I don't see it coming all the way back down and going negative. It could be wrong here. Things out there that we don't see. There's potential for conflict now internationally. It's been building. These are the things that can create chaos in our markets. Things we've been into is looking at the review of your full financial plan list, looking at those 5 key areas and your whole situation. And we've been doing that with a lot of you from the insurances around you, just life insurance, long-term care insurances, umbrella policies, that sort of thing, all the way to estate planning, trusts. If you have a trust, if you have a will, let's get them off the shelf and dust them off and just make sure, how do they read? Is it still right? How does your beneficiaries on your accounts look? Are they talking the same language? Do you even have a will or a trust? We've been looking at this a lot the last couple of years. We'll continue to do so. I'm hoping we'll bring another workshop on estate planning here soon. Get some of this pandemic stuff out of our hair here. And remember, with this volatility, as it returns, it's just part of the investment experience. Market pullbacks and downturns are not uncommon. This is more common. This is more normal. What we've seen the last 2 years have not been normal. We've had a market correction every year since 1950. This has been almost 2 years since we have the market correction. So this is more normal what we're seeing. Want to have a long-term strategy. If you're trying to hit it out of the ballpark with one stock, you could be trying a long, long time. You just want to have patience, have a long-term strategy, and staying away from the emotional investing decisions. It can help you ride the pullback wave and stay on track towards all your goals. And as a reminder, focus your time in the market, not timing the market. For example, selling equities during a downturn can help you retain your gains, but if you are still on the sidelines during an upswing, it can prove disadvantageous to the overall performance of your portfolio. Again, as our accounts have gone down here, think about how you can be adding to your accounts, not how you can sell and walk away from this. We want to be adding when times are down like this, because that same dollar is adding more shares, and that's what we want. Of course, if you have questions or concern, now's a good time to revisit your financial plan with us, including your time horizon and risk tolerance. As we meet with you guys this year, I've had several meetings already. I'm looking at all that. Again, we've been looking at that a lot the last couple of years. I think to have everybody in a really good position. I don't think we've ever been more ready for a market downturn than we are right now. Just a quick recap. Equity markets ended on a high note in 2021, despite many potential negative variables. Inflation is still expected to be prominent in 2022, and expect 3 rate hikes in 2022. But remember, that's not a given at any given time. The tapering efforts of the Fed will double starting in mid-January. So they've doubled they're going to end it by March. And right now they're set to do the first rate hike. The market's figuring March will be the first rate hike. If they do it sooner, it'll be a surprise to the market. The market will continue to be squirrely like this. Again, markets get goofy with the unknown, the unexpected. Volatility is clearly on the horizon. Caution and vigilance are critical. Be careful what you're speculating on. Bitcoin buyers, be very, very careful here. Remember, it produces nothing. You should focus on your own personal goals and objectives. And as always, give us a call with any concerns. Always, what can you expect from us? As always, as your financial professional, we're here to help you pursue your goals. One of our main focus is to review potential changes for you on an ongoing basis. Prior to making any financial decisions, we highly recommend you contact us. We can help determine the best strategy. I'd rather have you come to me at the beginning before you make a decision than come to me after when you think you've made a bad decision. There are often other factors to consider, including tax ramifications. It's a big one: increased risk, time horizon fluctuations when changing anything in your financial plan. Also expect regular communications and the confidence that we are continuously reviewing economic, estate, and investment issues for you. We spend a lot of time every week on this, staying updated on this stuff for you, especially in the tax review. Taxes have gotten very complicated. If they change again, I suspect that it'll be even worse. So this is why we do all these workshops. This is why we do all the virtual meetings like this. That's why we do the regular ongoing meetings with you. It's also, and then we put some fun in there too, but it's a way that we can see each other, talk to each other, and communicate quicker. So be looking for that. We've got our list of events here for the year. We've got it pretty well. Lacey and Dion have that pretty well buttoned down this year, and so we'll be sharing that with you as we move forward here. Appreciate you very much. As a benefit, if you know of anybody else that can use this information, that could come to our workshops and have this educational information, we'd love to have you bring them with you or send them our way. Just let Dion or Lacey know the workshops is where you can bring people. They can get the same information. We come on our list here and they can get these videos as well. And so we hope you take advantage of this and add a name or two to our list. It's how we grow. We appreciate you. We want to clone you. And we want more of you. Of course, one of our goals in 2022 is to help more people just like you. So some of our best clients were referred to us by you guys. So please feel comfortable sharing the names of anyone you feel could benefit from this. I believe the best client is an educated client. Our goal is to keep you informed, and we thank you for watching our update. And remember, client advocate meeting is one of the things on our events schedule this year. That is for people that share a name and put on our mailing list or bring somebody to a workshop. If you share a name, you get 1 ticket for a raffle at the advocate event. And if you bring somebody to a workshop, you get 2 tickets into the raffle. And we have a grand prize each year. And it's a very fun party. You can talk to others. And we try to keep that. So it's a lot of fun. This year is going to be a lot of fun. And we'll get it's for those people that gave us referrals last year. With that, thank you and have a great week ahead. And we will